Please join me in welcoming up to the stage this morning Ed Bull.
Thanks, Kev.
Welcome, Ed. Okay, Ed, well, welcome.
Thank you.
Let's talk about the investment market. It's probably the bright spot of the industrial sector at the moment. How are you seeing this sort of inquiry for investment grade stock at the moment?
Well, if we go back to, let's go back to last year. This time last year when we were sitting here, we spoke about $350 million worth of stock being floated around off market, being there for sale. Some of that did transact, some didn't. In the last 12 months, though, we've seen 400 million, as you stated, transacted in investment grade stock, which is down 7% on previous years, but it's still healthy. We've seen in the last 12 months a softening of yields, probably around 50, 75 basis points. So our prime yields now here in Brisbane are in that range of 8 to 8.5%. We've seen a few larger transactions this year in Brisbane, notably Toll at Larapinta, 514 Boundary Road, and the Growth Point purchase of the Property Solutions portfolio. So we have seen some larger transactions, which is underpinning that 8 and 8.5% yield stabilisation. What we've also seen is the re-emergence of the listed property trusts, having a look around in Queensland, that they might be underweight here. Probably notably Lend-Lease, Charter Hall, Dexus probably being the most aggressive at the moment. Nationally, we've also seen some of the largest transactions ever in industrial property. So portfolios such as Salter to the Singaporean GIC group for 210 million, and more recently this week the finalisation of the Dexus purchase of the Colonial portfolio for 230 million. So coupled with all of that, we see yields staying firm at 8 to 8.5% here in Brisbane for those prime stock. Secondary stock is still drifting, and if you're a private and you're out there hunting for that prime A grade stock and you're not in that 8 to 8.5% yield range, you might have to factor in some more risk into the equation, whether that be a short-term lease expiry or some vacancy, or hunting around off market, which I know a few do in here quite well.
Let's just pull you up on one point there. You talked about the REITs coming back into industrial. I mean, it's the one part of the investment market that's really been missing in Australia in the last couple of years is the REITs on the buy side. Do you think this starts to represent the REITs coming back into the domestic market? Yeah,
I think you can see that. You've seen some of those listed property trusts selling their offshore assets, notably ING, Dexus, and they're coming back into Australia. So, and a lot of them are underweight Queensland. So, okay. Yeah.
So it provides some scope for further activity from the REITs in Brisbane, you think?
Yeah, absolutely. I think you will see more activity. It's just a matter of finding that quality stock.
Yep. Okay. Let's turn now to the leasing market. I mentioned how pre-leasing has certainly dropped quite dramatically in the last couple of years. How are you seeing the leasing inquiry now?
It's probably a very hot topic with us as a group industrially, is landlords constantly being in front of them and them wanting to know how and when we're going to lease their property. It's one of the hardest things at the moment. We've got a tenant-led market. It's favourable to them at the moment, and they know that. There's a hell of a lot of stock out there in the market, existing stock that is. You can see just here in particular, this is stock 5,000 square metres and above in Greater Brisbane. We've identified 42 properties in total for a total of 410,000 square metres sitting there, which is existing, which can be filled immediately. So that's a lot to get through. What needs to be taken from that is there is a big differential in these properties in regards to location, efficiency, pricing. So if you are a landlord and you have a particular building, we can narrow that down and find out the true competition. But that's a general snapshot which we have to get through over the next 12 to 18 months. What we've seen is the sub 5,000 square metre stock, there's probably more properties in total, but there's greater turnover and greater brokerage activity in that market. So, yeah, I see rent stabilised for the next 18 months.
Yeah, this is quite a bit of stock to absorb, and this is part of the Brisbane issue that I don't think exists in other parts of Australia, but this issue of having to absorb this existing stock is very important. And it's interesting that chart I put up earlier because it showed total construction on average might be around 500 to 600,000 square metres per annum in Brisbane, and maybe 70% of that would be pre-let to the bigger end of the market. So it's possible that the actual back of the envelope demand per annum in Brisbane is around about 400,000 square metres. So it could take a year or two, given that we're moving still into recovery, to actually absorb this stock. So to me, it's not dissimilar to what the picture is and the story is in the office sector. Yep. So let's talk about a bit more detail about the pre-leasing. We've seen it in Sydney and Melbourne. What's the story in Brisbane?
On the pre-lease side of things, I suppose we still do have tenants not looking for the existing. They need greater scale or greater efficiencies. We did see a flurry of activity in the back half of 2009. We went away back in 2009 thinking that would continue. The start of 2010, first half, was very, very tough. We've seen very, very little transactional activity in the pre-lease market this year. I think there's been one or two out there of note. Probably the one to mention would be the Reece commitment of 25,000 square metres to Trade Coast Central. There is another large requirement out there in the market at the moment for Kmart, 50,000 square metres, which is rumoured to be down to 2 in the Gateway and Port Precinct. But we thought we'd see a lot more activity on that front. We haven't. We thought we would have because of the decrease in the land prices, also the favourable incentive market that's out there for tenants at the moment. But I think what they've been doing is concentrating on down south Sydney and Melbourne. They've seen a hell of a lot of activity. Western Sydney alone committed 250,000 square metres in the first half of 2010. And that was mainly retail-related distribution centres. So it relates specifically to your container port graph that you had up earlier. So we're hoping that they're set now in Sydney and Melbourne, and they'll be coming north in the next 6 months.
Yep. Okay, so is there any sort of final words of wisdom or key strategies you'd like to leave clients with for the year ahead?
On the investment front, I think if you're a private investor, you need to be continually reassessing the market and seeing where yields are. And if you're not in that 8 to 8.5% range, you need to look at more risk, whether that be shorter lease expiry or vacancy, as I said. I think there's also opportunity for the fund-through deals on the pre-lease deals when they do come. There is also landlords. I'd be getting in front of all your tenants. If you've got a lease expiry in the next 18 months, I'd definitely be getting in front of your tenants and trying to lock them away on a longer term, offering some incentive. If you're outside, if you're 2013 onwards, I think I'd hold tight and wait for that recovery. And you'll be there in the driving seat. And I think the pre-lease market, although I believe that'll come next year, I think it's going to be highly competitive as developers try and generate construction activity and build costs come down and incentives. So that's where we see it.
All right, great. Okay, well, there's some good thoughts there and insights for the year ahead.